When we look at the results of traders, their profitability, it turns out that only a modest fraction of the success comes from the actual ideas that they're trading. The ideas are important, but they're not all important. Once you have the idea, you still have to structure that idea as a good risk-reward proposition to turn it into a trade. And that's a very detailed area of exploration. So if I have an idea that the global economy is growing, that there's going to be economic expansion overseas, that will carry over to certain international companies in the US, great, that's a worthwhile idea, but where do I buy? Where would I sell? How would I structure that trade? Would I think about using options and limiting the amount of premium that I dedicate to the idea? Might I structure it as a spread trade or a relative value trade? I'll buy this industry and sell another industry against it. There's so many different ways of structuring an idea, so many different ways of timing and sizing an idea. Those are the mechanics of trading, and they account for a surprisingly large degree of success or failure of traders.
That's where real trading begins. Not in the idea itself, but in how you bring it to life. Every great trader has learned this. Success comes from structure, repetition, and emotional control. In today's video, we'll explore 10 timeless truths that top traders and investors never ignore. Insights that reveal what really separates consistency from chaos. You'll hear from some of the most respected minds in the trading world: Brett Steenbarger, Francis Hunt, Tom Hougaard, Alexander Elder, Howard Marks, Darren J. Miller, David Paul, Warren Buffett, Phil Goedeker, and Larry Williams. Each of them brings a different angle, from psychology and mindset to patience, risk, and survival. But together, they form a complete picture of what it truly takes to last in the markets. If you've ever wondered what the best traders actually focus on beyond charts and indicators, this is your chance to find out. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let's dive in and start with the foundation that every trader must master: preparation. Because knowing what to do means nothing without preparation. Francis Hunt explains how real confidence comes from doing the work long before you click that buy or sell button.
I think analysis, not the actual trading. The amount of work and drawing you do on your chart, actually taking in, is what gives you the confidence. I've always found I'm most confident on a trade when I've really opened the chart up. Historically, I've looked to see how it's performed. How's it continued before? Drawn the patterns, projected the targets, were they made, thrown all my key levels of significance through the chart, seen it's come back, visited, supported, moved back up. Really got inside the price behavior that I feel I understand this animal. You know, you wouldn't start committing surgery on a being that you've never studied before. Why would you start trading something that you've not properly got under the skin of?
That's the kind of preparation that builds real confidence, not from guessing, but from understanding. When you truly know how the market behaves, every trade becomes a measured decision, not a reaction. But here's the thing. That's where most traders stop. They prepare, they analyze, they study, and then they do exactly what everyone else does. The next step is harder. It's where you stop following the crowd and start thinking for yourself. And that's exactly where Tom Hougaard comes in. He's built his entire career on challenging conventional wisdom, questioning what everyone else does, and finding where the real edge lies. Because in trading, following the majority rarely leads to exceptional results. Now, Tom explains why being different isn't just a mindset. It's a requirement for survival in the market.
When a market makes a 61% retracement, some would argue that this is the ideal time to either buy or sell short depending on the direction. And if that fails, then there's also the 78.6% retracement. And hell, why not throw the 88.6 and the 94.5% ratio? So there's always a ratio for the particular season. However, my argument is that if the market has already traded up to a 78% retracement, surely if you sell short at 78.6, you're actually betting against the prevailing trend. Some would argue against me. I'm not really so interested in what other people are thinking. I am more interested in trying to explain to you that the majority of indicators are available to the majority of people. Yet, considering that 75 to 80%, maybe 90% of all people engaged in trading are losing, maybe it's a time we have a real long, hard look at what it is that we're actually doing when we're trading.
What Tom shows us is that thinking differently isn't about being rebellious, it's about being aware. Most traders react to what they see, few question what it really means. Standing apart from the crowd requires courage, but it also builds clarity. And clarity is what separates those who survive from those who fade. To see clearly, you must understand not just the charts, but the crowd itself. That's where Alexander Elder takes us next, exploring how market psychology and emotion shape every major move, and why recognizing fear and euphoria can make all the difference.
When markets are happy, that's when they top out, and that's when they go down. When markets are depressed, that's when sellers come out of the woodwork and everybody sells the markets, and eventually there are no more loose shares to be sold. And so depressed markets bottom out. We have indicators which help us identify happy markets and sad markets, depressed markets. There is put-call ratios, commitment of traders, also not to be forgotten VIX. When VIX is low, go slow. When VIX is high, it's safe to buy. VIX is a fear index, so when VIX is high, fear is rampant, that's a safe time for buying. When VIX is low, the crowd is complacent, and that's a dangerous time. When a market blows out of its channel, when a market creates a bearish divergence, when you hear this happy news of IPOs, well, that's a happy market. And that's when I start looking for shorting opportunities. When a market is depressed, when it falls out below its lower channel line, as the stock market has done about a week ago, when the news are gloomy, that's when I become interested in creating a shopping list. And by the way, one of the troubling things about the market today is that after this decline we've had since late April, VIX has never picked up. VIX is still at 20. The crowd is complacent, the crowd is not fearful, and that's why I'm quite cautious about what's happening today. I don't think we have seen the bottom of it yet.
Elder reminds us that markets move with emotion, optimism, and fear constantly trading places. Recognizing these emotional extremes helps us step back, observe the crowd, and act with reason instead of reaction. The best traders don't fight emotions, they read them, turning crowd behavior into opportunity. But even when you understand the market's emotions, there's another challenge that every trader faces: internal pressure. The pressure to perform, to always be in a trade, to make money every single day. That's where Darren J. Miller steps in, exposing how this constant need to prove yourself can destroy focus, and why mastering simplicity is often the smartest path to real consistency.
Definitely need to focus on the risk. It's one of the most overlooked factors of a lot of people. You'll see a lot of that in currency markets with the leverage options markets the same way. You know, if you don't define the risk, you never know how much you can lose. That's unhealthy. That's unhealthy trading behavior, and you'll walk away from the market jaded and broke. I want to focus on not feeling forced to trade. I know that some people feel that if they're not in the market, they're not making money. And so they feel that pressure, and it's undue pressure. A lot of people approach the market and say, you know what, I need to make X number of dollars a day to replace my income. And so they build on that force and put that undue pressure on themselves, to be a profitable trader. And then you start to see trades being forced, low probability trades. Your broker's happy, they're making money, but at the end of the day, your profit and loss is probably less than favorable because you forced trades that just weren't there. I think it's important to not try to know everything. Don't feel that pressure. It's okay to focus on a specific sector. It's okay to focus on a specific strategy.
Miller's message is a reminder that trading isn't about constant activity. It's about controlled precision. When you stop chasing every move and start focusing on quality over quantity, pressure fades and performance improves. Simplicity becomes a form of strength, and that simplicity connects directly to discipline. Once the noise is gone, success depends on having a clear process. A single edge you can trust and repeat. Dr. David Paul takes that principle to its essence, showing how one pattern, good risk management, and consistent execution can build a lifetime of profitability.
Our job is to find an edge in markets. All you need is one pattern. That's all. You just need one pattern to be successful. The head and shoulders pattern could be your pattern. He put a chart up of lots and lots and lots of patterns. I love my wedges, falling wedges and rising wedges. I'm very fond of my fib levels and harmonic patterns, which are my own personal edge in both the stock market and in the forex market. But you need one middle pattern. You need to practice really, really good money management, and that just means not losing any more than 1% of your loot, or at the very most 2% of your loot on any one trade. And then the third thing is to build the discipline to just do it over and over and over again.
Dr. David Paul shows that consistency doesn't come from complexity. It comes from repetition. Finding one pattern, mastering it, and protecting your capital turns trading into a disciplined craft instead of a gamble. True professionalism isn't about doing more. It's about doing the right thing over and over again. But even with discipline, there's one more temptation that can destroy good traders: impatience. The urge to trade just to feel productive, to force opportunities that are really there. Phil Goedeker tackles this challenge head on, explaining why waiting for the right setup is often harder than taking the trade itself, and how patience becomes the most underrated skill in the market.
Now, trading can be a difficult profession. For that, we sit in front of our computers all day long, and we feel unproductive if we're not always in a trade or pushing buttons. We follow traders on Twitter who tweet a new idea or ticker every 35 seconds, and we say, hey, that guy trades 80 to 90 tickers a day. I need to do the same thing. No, I think that's BS. I think you should not do the same thing. I think you need to stick with your high probability setups, the setups you know you're going to be profitable on. I'd say at least 75, 80, hopefully 90% of the time. Now, sometimes it can be hard to sit on your hands and be patient and wait for those setups. But why chase subpar setups? Why chase boredom trades? Why put good money after bad?
Goedeker reminds us that patience isn't passive. It's a strategy. Knowing when not to trade is as powerful as knowing when to act. By avoiding boredom trades and low probability setups, you protect both your capital and your confidence. Sometimes doing nothing is the smartest move you can make. That same mindset applies on a bigger scale, not just in trading, but in investing. The idea of waiting for the right opportunity, of understanding value before taking risk, lies at the core of long-term success. Howard Marks brings that perspective to life, explaining how price, expectations, and experience define the difference between a good investment and a dangerous one.
So it was very, very important then to be in an area where the surprises were likely to be on the upside. And if you buy the bonds of B-rated companies about which there are such low expectations, maybe it's easy for there to be a favorable surprise. Now, how can I prove to you that the expectations were low? The answer is that if you look in the Moody's guide to bonds in those years, what was the definition of a B-rated bond? Quote, fails to possess the characteristics of a desirable investment. In other words, it's a bad investment. Now, I drove here from the airport in my car. And if I take you outside to look at my car and I offer it to you for sale, because I don't need that car anymore. When I'm done here, I'm not coming back. If I say to you, would you like to buy my car? What is the one question you must ask me before saying yes or no? Price. You get an A. So, in other words, it's a good buy at a certain price. It's a bad buy at another price. Moody is now saying that B-rated bonds are a bad buy without any reference to price. So, in other words, there's no price at which a company that has some credit risk is worth investing in. And by the way, before I turned to high-yield bonds in '78, I was part of the bank's machinery to buy the bonds of the stocks of America's best companies. And I explained at lunch how if you bought the bonds of Hewlett-Packard, PerkinElmer, Texas Instruments, Merck, Lilly, Xerox, IBM, Kodak, Polaroid, AIG, Coca-Cola, and Procter & Gamble, and if you bought them all in '68 and you held them until '73, you lost 90% of your money. Why? Because they were overpriced. The average stock since the post-war has traded at 16 times its next year's earnings. These were trading at 80 and 90 times. Why? Because they were so good. Everybody says, this is great companies. Nothing can go wrong, so it doesn't matter what price you pay. And if you pay 80 or 90 times, that's fine. So here we are, in my experience, again, experience as a teacher. You invest in the best companies in America, you lose a lot of money. Then you go to the high-yield bond business, you invest in the worst companies in America, you make the most money. So it's an instructive lesson if you have your eyes open and you learn from experience, which I did.
Marx reminds us that the biggest lessons in investing come from experience and from recognizing that even great companies can be terrible investments at the wrong price. Value isn't about perfection. It's about perspective. The smartest investors aren't looking for the best businesses, but for the right opportunities at the right price. And no one embodies that principle better than Warren Buffett. His philosophy is built on patience, the discipline to wait for the right pitch, instead of swinging at every opportunity. Up next, Buffett explains why understanding when not to act is often the key to long-term success in both trading and investing.
Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram, shows him at the plate. And he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw any stock, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game, and it's a terrible mistake to think you have to have an opinion on everything.
Buffett's wisdom reminds us that the market rewards patience, not speed. You don't have to swing at every pitch, only the ones that truly matter. That mindset turns discipline into opportunity, and waiting becomes an edge of its own. The power lies in doing less, but doing it right. And that brings us to Larry Williams, a trader who's seen it all and understands what really keeps people in the game. Beyond skill, beyond strategy, it all comes down to survival. Because no matter how good you are, if you can't stay in the game, you'll never reach the wins that matter. Larry closes this journey with a timeless truth. Trading isn't about brilliance. It's about endurance.
I worked with probably 100,000 traders and investors literally throughout the world. My books are in every major language of the world. And I really looked and worked with these traders to see what separates, what makes a really successful winning trader. And you know what I think I've seen in all of these people? They're absolute survivors. Some are not what you would call particularly intelligent. They're not bright. They're not gifted mathematicians. They may have a background like mine in journalism and writing, or they might be a car mechanic. Or they come from all walks of life, but they just have that strong desire to survive. And I don't know quite where that comes from. I don't know quite how to teach that to you or how you can become that, but it's something I think you need to have as a model. It's all about survival, not losing your money, staying in the game, not betting big, so of course you can stay in the game, but you increase your ability to survive and you're going to become a much better trader or investor.
Larry's message brings everything full circle. After all the analysis, all the psychology, and all the discipline, what truly defines a trader or investor is the ability to endure. Survival is success, because if you can stay in the game long enough, the odds eventually turn in your favor. That's the ultimate truth behind every legend of the market. Let's take a moment to look back at the timeless lessons these great traders and investors shared. It all began with Brett Steenbarger, who reminded us that success isn't just about having good ideas. It's about structure, discipline, and execution. Because even the best idea means nothing without a plan behind it. Building on that, Francis Hunt showed that confidence comes from preparation. The deep, methodical work that turns uncertainty into understanding. When you truly study the market, you stop reacting and start responding. Then came Tom Hougaard, challenging us to think differently. He proved that doing what everyone else does only leads to average results, and that true edge comes from questioning the crowd and seeing what others overlook. Of course, to understand the crowd itself, you have to look deeper. Alexander Elder revealed how emotion drives markets, fear and euphoria, creating endless cycles that traders must learn to read, not resist. But even when you understand the market's emotions, you still face your own. Darren J. Miller reminded us that pressure and the constant urge to trade can destroy focus. Real progress comes from simplicity, knowing that less can often mean more. That clarity leads straight to David Paul, who emphasized the power of repetition and discipline. You don't need 1,000 strategies, just one edge you can master and repeat with precision and control. And with control comes patience. Phil Goedeker showed that sometimes the smartest trade is the one you don't take. Avoiding boredom trades and waiting for high probability setups is how professionals protect both capital and mindset. That patience naturally connects to Howard Marks, who took the idea further into investing. He reminded us that price always matters, that even great companies can be terrible investments when expectations are too high. True wisdom lies in recognizing value, not just greatness. Warren Buffett then reinforced that truth, showing that waiting for the right pitch is more powerful than swinging at every opportunity. In markets, as in life, patience compounds just like capital. And finally, Larry Williams closed with the lesson that ties it all together: survival. Because no matter how skilled or intelligent you are, the ultimate edge is endurance. Stay in the game, keep learning, and time will do the rest. In the end, these 10 voices echo a single message. Trading and investing are not about speed, prediction, or perfection. They're about mindset, patience, and the will to keep going. And as you move forward, keep that message close, because growth in the markets, just like mastery in life, happens step by step, lesson by lesson, experience by experience. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.